Hello and welcome to the Business Standard Banking Show. Utkarsh, which was a microfinance institution, started to operate as a small finance bank in 2017. Headquartered in Varanasi, the bank has a strong presence in the rural and semi-urban areas with 830 branches. We today have Govind Singh, the Managing Director and CEO of Utkarsh Small Finance Bank, to talk about the journey so far. Mr. Singh, welcome to the show.
Thank you, Manojit.
As on March 31st, 2023, the loan book of the bank was close to 14,000 crore. How much was the growth in FY23 as compared to the previous year?
So our loan growth in 23 has been around 31% if you compare to the previous year. And uh, I'll use the word now we are almost out of COVID. So we are seeing a normal growth as far as the loan book is concerned.
And what kind of growth you have seen in the deposits?
So deposit grew by around 36% last financial year, and I mean we are seeing a good traction in deposits also. During this period we could open many new branches, and we are seeing a good traction in both sides, advance and deposits, because of the larger network now.
Of the 14,000 crore loan book, what is the share of MFI loans in the total loan book?
So MFI is close to 65% in the overall book of ours, very close to 9,000 crore in fact, I mean the rounded number. And we are seeing that, in spite of being a bank, we are seeing a good growth in microfinance space also. But if in terms of percentage, the others are taking over because they are the new businesses. Then the percentage is higher than microfinance for sure.
But going ahead, I'm sure you want to de-risk the balance sheet a bit more. So, what is the ideal combination you look in your loan book in terms of how much could be the MFI portfolio and how much could be the others?
So I think it's a journey. I may not have an exact number where we will reach, but if you see our trajectory for last few years, every year we are seeing an increase in non-microfinance book by 5-6%, because of the, you can say, low base. And the way things are happening, I think looks like that this same trajectory will continue for some time. So certainly, the share of microfinance will come down and share of other book will keep going up from here. What has happened, Manojit, during last 6 years of existence of bank, we have created new verticals like MSME, affordable housing, wheels, small corporates, and now they are seeing much better growth, because initial 2-3 years it takes to set up things, put products in place, put technology in place. That has been done. So now we are seeing a good traction, and it's a regular traction now. It's a normal business as usual for these other businesses also.
Now, coming to the asset quality part, most of the small finance banks saw a rise in bad loans in FY23 due to COVID-related non-payments. How has been the Utkarsh Small Finance Bank's experience?
So we also had some challenges, but that was more in the year 21 and 22. During this COVID period, especially because when you have microfinance type of businesses, me reaching out to the customers, meeting those customers, and a lot of people also lost their livelihood during that period. So certainly, the stress assets or overall NPA grew during that period. But if you see last year onwards, it's almost a normal year, and there are some you can say spillover of previous year or slippages because of the still some challenges of COVID. But otherwise, it's almost a normal portfolio right now, and we are seeing a significant decline in overall NPA and net NPA during the last year, and this trend looks like it will continue.
So far as capital is concerned, you're raising funds through a public issue, but your capital adequacy ratio is pretty healthy at around, I think, 18%. So what was the reason for raising capital? Is it because of regulatory requirements?
So there are both the reasons. One is the regulatory requirement also is that RBI expects that we should list the bank, and so that is one part, because you should be widely held, the way the regulator expects. That is one part. Having said so, but we will be comfortable if we are around 18-20% all the time, because two reasons. One is that we are a growing bank where we have a small balance sheet, and the growth percentage will be higher in going ahead also because of the low base. That is one part. And second, also whenever there are some shocks, because of some challenges, a slightly higher capital is always useful in those scenarios also. So growth as well as to conserve capital, I think both the things are important to raise this capital. And this will take care of our growth for next 18 months, 21 months type of whatever growth we require to.
So next 18 to 21 months, this capital will enable you to grow.
So again, it's very difficult to predict what is the exact timelines, but certainly because our capital adequacy will go by 3 to 4% because of this new rate, that will take care of our next, you can say, as I mentioned, 18 to 21 months requirement for sure.
And what is the impact on capital adequacy ratio because of this capital infusion?
So it will go up around 3.5% for sure. From around currently we're around 20%. If you look at March numbers, so it will be in the range of 23 to 24% based on at what price finally it gets allocated. But that's the ratio, that's the range we'll have.
And what kind of provision coverage ratio you had in the FY23?
So we're very close to very close to 90% our provision coverage ratio, and we are a conservative bank that way. We keep we always keep high provision because it is better to absorb the shocks as early as possible. So PCR will one of the things which we always ensure that we have a higher, and we have seen a growth in this, increase in the PCR, so that the net NPA becomes very, very low.
Also, the banks has reduced the issue size by about 63%, and there was no offer for sale. We would have reduced the promoter stake. What was the reason for reducing the size?
So two things are there. See, our primary raise is very close to what we are supposed to do because we raised 150 crore last year also. So this, if you look at 500 crore now and 150 crore, that takes care of my primary requirement or my tier 1 requirement for sure. For secondary, the thought process, because we have the long-term investors, their idea was first we should list the bank, then see for some time, and then they see what are the processes through which they can, exit. Because we don't have any individual investors who are looking for, you can say, secondary. It was the holding company run by, led by various investors. So they are not keen right now on secondary. They want to see first the performance of the bank and see how the market looks at us, and then look at the ways to exit from the bank or from the holding company.
Now, Utkarsh has a very diversified shareholding pattern. But what is the promoter shareholding now, and what would be post the IPO?
So we have a two-tier structure. We have a holding company which is the promoter for the bank. So they currently hold around 84%, and post IPO it will come below 73%. The overall dilution. But if you look at our even holding, the promoter of this bank, that is Utkarsh Core Invest Limited, even that is well diversified, shareholding pattern. Like people like CTC and Avishkar and RBL Bank, Fairing Capital. So it's a very well diversified book, even the holding company part.
Now, related to capital, RBI has recently come out with a discussion paper on expected credit loss based loan loss provisioning. What could be the impact on the bank after you transit to the ECL framework? And do you think ECL norms could pose a challenge to smaller banks?
So at least the type of activity we do, if you see, especially those who are into unsecured lending or microfinance space, they will I'll use or provide early, in fact, than those who are secured businesses. That's one part. Second, we are anyway, we are making Ind AS, on a regular basis, and we have not seen much impact of Ind AS, and if I just mentioned, we are taking additional provision in terms of floating provision also. So those all are helping us. So we don't foresee any significant change. Sometimes it will be helpful also because there are some positive things in that, even in the Ind AS part. But we don't foresee any challenge moving to Ind AS whenever Reserve Bank of India decides to move on.
You have also ventured into gold loan, so that will help.
Gold loan will help, but gold loan, we have not seen. Gold loan is not a very sizable business for any of the banks. It's a good secured business. So I'll use the word that it is good business to have with you, but it is not going to have, for example, none of the banks will have, other than gold loan companies, will have 5%, 10% portfolio from gold. So because gold portfolio doesn't grow that fast. So certainly it will help us, but we have not seen very rapid growth or very fast growth of gold loan businesses. So when we look at lab type of businesses or affordable housing or wheels type of businesses, there the growth rate is much faster.
Thank you so much, Mr. Singh. It was a pleasure talking to you. Thank you for speaking to Business Standard.
Same here. Thank you very much for this call, and look forward to meeting you once again shortly.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.